The next time the system freezes up and collapses, which we all know is inevitable, now that we've been conditioned to believe that the Fed is totally in charge, we'll be conditioned to think that we'll just swallow whatever the Fed says has to happen next.
Hi, and welcome to the X22 Report Spotlight. Today we have a returning guest, Craig Hemke. He is a securities professional for over 20 years. He's the creator and owner of TF Metals Report. That's tfmetalsreport.com. And I am very happy to have him back on the X22 Report Spotlight. Craig, welcome back to the Spotlight.
Dave, it's always a pleasure. Great to visit with you again.
Thanks for being on here. And I wanted to start out with the job numbers that came out today. And looking at the job numbers right now, it looks like we're still at 4.9%, and it wasn't as good as they thought it was going to be. And we hear the Fed, they might put off the rate hike a little bit. What do you make of these job numbers and the Fed rate hike? Do you think they're playing this game where they really don't want to raise the interest rates?
Boy, that question alone might take all our time, Dave. There's a lot there. First of all, you start with the number itself. Today, as you and I speak, it just came out. It's the 2nd of September. It was released at 8:30 Eastern, which means it was compiled on the 1st of September. And we're supposed to believe that some government bureaucrat is able to tell us on the 1st of September how many jobs the entire U.S. economy added in August. I mean, right there, that should set off a red flag, right?
Yep.
Okay. This is all statistical guesswork. And even within the statistical guesswork, all the jobs are once again in the retail, the bartenders and waitresses category, and part-time, because nobody wants to hire full-time employees because of the regulations and Obamacare and everything else. But nonetheless, that doesn't fit the narrative. We were told earlier this week by Fed goon number 2, Stanley Fischer, that the U.S. was near full employment, he said. Full employment. What was the number this morning of people not in the workforce? 94 million?
That's correct.
So I can't really square those two things, Dave. Full employment with 94 million people not in the labor force. But
those people don't count.
That's right. That must be what it is. They're the invisible people. Again, it doesn't really matter what you and I think. There's a narrative that's put forth by the Fed, and then their primary dealer banks, and then the sycophant media, which relies on both of them for their ad revenue and everything else. And that is somehow that things are great. What's really astonishing this morning is that we were told all week that, the jobs number is going to be strong like they allegedly were in June and July, and therefore now the Fed's going to hike rates. We've been warned about that for over at least a week, for several weeks now. Yet the jobs report was well below expectation, but nonetheless, everybody is still saying that this now clears the way for the Fed to hike rates in September. And I'm like, I don't know. Dave, I wrote something about a week ago, and I still feel this way. And it's that we're all being conditioned in the classical psychological sense. And what I mean by that is, conditioning is this kind of Pavlovian, Pavlov's dog type thing. You ring a bell, and after a while, since the dog gets fed, when there's a bell rung, the dog begins just simply to salivate with the bell. I think that what we're being conditioned to believe here is that the Fed is omniscient, omnipotent, and this altruistic, benevolent organization that's out to save us all, and that every muttering that they say is the most important muttering of all time, and that they alone control the economy with what they say, and that they alone, by extension, can save us all the next time something happens. I mean, it's been proven now. I mean, a guy by the name of John Titus went back and got all the actual notes after a 5-year embargo of what the Fed was talking about in 2009 and 2010 when they jammed TARP down the throats of Congress. And it was all lies. They lied that the commercial paper market was seizing up. They lied that economic activity was stalling because they needed the $700 billion to shore up their member banks. The next time the system freezes up and collapses, which we all know is inevitable, now that we've been conditioned to believe that the Fed is totally in charge, we'll be conditioned to think that we'll just swallow whatever the Fed says has to happen next. So, yeah, I don't know if the Fed's going to raise rates in 2 weeks or not. And frankly, I kind of wish they would because I'm sick of this game, the job owning game. And all I know is, they didn't raise rates all through 2012 into 15 during QE, and gold, since it was tracking the yen, went straight down. Well, once they raised rates back on December the 16th of last year, gold bottomed the very next day at 1,060, and it's up 25% since. So maybe, Dave, we should all be pulling, if you want gold to go higher, we should be polling for higher rates instead.
Just this past week, we've seen gold suppressed quite a bit.
Yeah.
They have been really suppressing it. Why are they doing this? I mean, in your mind, why do you think they're suppressing it right now? And how did they do it, actually?
Well, the primary thing that most folks need to remember is that the group that I guess ostensibly de facto is in charge of the paper markets that make a market are these big bullion banks, everybody from JP Morgan, Goldman Sachs, Deutsche Bank, Barclays, UBS. All these bullion banks are the ones that are primarily responsible for issuing the paper derivative contract. And remember that price you see, the price that's quoted on CNBC, the price that's quoted on Bloomberg, that's, I guess, in a sense, it's a price of gold because the spot market kind of follows it and the London fixes kind of follow it. But that price is the paper derivative price. And it's only really a function of the supply and demand for that derivative itself. And that's where these banks play a role because they're the ones that are in charge of the supply. They're the ones that issue all the shorts, take the short side of the trade when the longs are buying, when the spec longs are buying. And so at present, after watching open interest and total amount of paper derivatives explode in the first half of this year, we're seeing those paper derivatives come back out. The banks which were at one time and this is just on the COMEX based off the CFTC reports, just the banks themselves were net short 200,000 COMEX contracts. Okay, that's 20 million ounces of gold, meaning that every $10 move cost them $200 million. So you ask, why are the banks trying to rig price lower? It's because they're trying to flush these specs back out so that they can buy those shorts back before price moves higher again. Where we see the dramatic manipulation, not so much really on a daily basis. I mean, though they're out there doing what they can, but boy, every once in a while you really see it. We saw it, I don't remember what day it was last Wednesday. Price had come down and was riding the 50-day moving average, which is kind of a key short-term technical indicator for a lot of these hedge funds and technical trading funds and algorithms as to whether they're going to buy the dip or sell the rally. And it was riding it for 5 or 6 days. And then out of the blue, all of a sudden, at about 9:30 in the morning one day, I think, again, this was 9 days ago, 2 orders back to back, 1 second apart. It was caught by Scott Hunsater at Nanex. One order for 1,400 contracts, another big dump of 1,200 contracts. Again, 2 of them, 1 second apart. Drop price $10 in an instant, broke the 50-day moving average. And we have been in kind of a steady down move ever since. And the banks knew that would happen. They know that triggers these trading funds to be more apt to sell the rally than buy the dip. And that's all part of why we've since deteriorated. Gosh, we got all the way down to 1305 or 6 the other day. So everybody needs to remember that the banks are still in control. The banks are still going to do whatever they can to mitigate their losses and try to profit from all this paper trading. And that price you see is just, found by that paper trading. At least that's the system we have now. Until that system fails, it's what we're stuck with.
Harry Dent was on an interview, and he was saying that gold is going to be going back below 1,000. Do you see that happening? I mean, where is he getting that from?
Harry Dent's trying to sell subscriptions, which is what he's done for as long as I've known of him, which is now almost 25 years. I wouldn't trust that guy any farther than I could throw him. I consider him a snake oil salesman of the lowest order. Let me just go back and read you a little bit of a snippet from Harry, just so you know. This is from Monday, September 12th, 2011. Okay, this is when gold was 1,900, something like that. Very close back then to when gold was peaking out. The Dow back then, I don't even know where it was, 11,000, something like that. This is a CNBC article from that day. Dow could crash to 3,000 in 2013 is the headline. And it goes on to say the recent gyrations in global stock markets are just beginning, says U.S.-based economist and author Harry Dent, who believes the Dow will fall below 10,000 in the near term before crashing to around 3,000 in 2013. So I don't think we made it to 3,000 in 2013, did we, Dave?
No,
do you recall? I'm really kind of scratching, trying to figure out. I'd say Harry was kind of dead wrong on that one. When you just like as Harry was dead wrong in 1991, when he told everybody that by the end of that decade the Dow would be 36,000. Look, I mean, this is a scam. You just make these outrageous predictions. You get people to buy your book. When you're wrong and then they all fail, you make some new outrageous prediction. You hire a PR firm to help you pimp your book and pimp your subscriptions, and you just keep churning and burning people. I have zero respect for people like Harry Dent. None. And nobody should listen to what he says.
So where do you think gold is going right now? I mean, there are some people saying that, gold is going to skyrocket very soon because the delivery, the physical demand is out there and prices are going to start to skyrocket. But we see the banks, the central banks, they still have the ability to suppress. So
right.
How is gold going to rise if they're continually suppressing?
All right, I'm going to give you kind of a long-term answer and a short-term answer. Because again, got to remember, I mean, when we're talking about the price, we're talking about the paper derivative price,
right?
Which is a function of supply and demand of said derivative, okay? Now, in the long term, what we're seeing, particularly in Europe, negative interest rates is the single greatest fundamental for physical gold that we have ever seen. There was an article this week about safe sales in Germany going through the roof and people withdrawing cash from the bank. This is why you're seeing these trial balloons all the time about eliminating cash, or at least eliminating the largest bills. Because in negative interest rates, what's the natural response? You go, okay, just give me my cash then. I'll store it myself. I'm not going to pay the bank 1% a year, right?
Correct.
So now you've got all of these central bank goons and their authors and economists that are in their back pocket writing about how cash needs to be eliminated. And you see that now on almost a daily basis. Well, why do they want to eliminate cash? So that you can't deleverage the system by withdrawing your cash, so that you have to keep it in the system and pay the banks. Okay? All right, well, if you can't fill your safe with cash, what's the next best thing? You take your cash and you buy some physical metal. You buy physical gold, you buy physical silver. That negative rates are the greatest physical fundamental we've ever seen. Physical demand and taking the metal out of the bank's hands is what will ultimately break their paper derivative system. However, everything always comes with a big but. In the short term, I mean, unless that happens next week, we're going to be subject to the whims of the paper trading, how the HFT algos, the high frequency traders, or whether they're looking to buy paper metal or sell paper metal. And then as we discussed earlier, we got the banks with these massive short positions that are desperate to cover them and get out from under them so that then, if they need to lay them on again in the future, they'll have that ammunition in their back pocket. In the short term, a lot of the demand for the paper derivative of gold this year has come from these HFTs, these spec funds, these hedge funds, these just trading, algorithmic-based trading funds. And why are they buying paper gold? Well, two of the key inputs that influence the decision of these algos, whether or not they're going to buy or sell paper gold, are the dollar yen, the symbol USD JPY, and whether that's going up or down. And then also the bond market, whether interest rates are going up or down. Well, we've watched the dollar yen decline almost 20% here in 2016. And while that's been going down 20%, the price of that derivative of gold's gone up 25%. The problem is that dollar yen has been aggressively defended, the falling dollar yen, for the last 2 months at about the 100 level. It got down to nearly the 100 level again last Friday morning after Yellen's speech. And then all of a sudden we had Goon Fisher. I call them all goons because I just think they're all, I don't have any respect for them either. Goon Fisher comes out and talks the dollar up and the yen down, and makes the dollar yen move 3-4% now in a week. And in doing so, at least as we're speaking this morning, the downtrend in the yen that has driven it lower, that dollar yen, that's driven the dollar yen lower and gold higher by extension, it has been going on since January, has been broken today. So putting this all back together, and I hope this makes sense to everybody, I think there's a pretty good chance in the short term that these algos sell some of their paper gold based on the dollar yen going higher. And the bond markets looks like it's selling off, and interest rates are going higher too. So if it does work out this way, if we do close that way today, if these trends are exacerbated next week, we're probably in for a period of some tough sledding for the next few weeks at least until we get to the FOMC meeting in a couple of weeks. But long term, all this job owning, all these Fed rate hikes, all this other nonsense. I mean, QE and negative interest rates really seem to be here to stay. And as long as they're here to stay, that's going to drive physical metal demand. And it's physical metal demand that ultimately gives us our best chance of breaking the banks and breaking their paper derivative system.
So how important is it for people to have physical gold or silver right now?
Which is extraordinarily important, Dave. It always has been, just as an insurance policy of the system seizing up and breaking down again. It's never something, I've never, ever in the 6 years I've done this said, oh, you got to go out and take everything you got and buy all the gold and silver you can. Some people, unfortunately, have done that, thinking, a great way to make money, I guess. At the end of the day, it's an insurance policy. Now, you've got to determine for yourself how much insurance you need. If your house is only worth $100,000, you don't need $1 million worth of homeowners insurance, right?
Right.
I'm sure they'd let you do that anyway. Mm-hmm. But if your house burns down, you're pretty glad you have your homeowners insurance. And that's really what owning physical gold and silver are. They are insurance against your net worth, your accumulated savings being burned down in this fiat fiasco that ultimately is coming. Just as you insure your house in case it burns down, just in case you insure your car, in case you get in a wreck, just in case you insure your life, just in case you drop dead one day, you insure your net worth with physical gold and silver. And the importance of owning it and having it now is that when the time comes and all of this, does finally play out and the paper derivative system breaks, you're not going to be able to get gold and silver, at least not at a price most people can afford, because this paper derivative system is based upon almost like a fractional reserve gold banking. I mean, every ounce of metal that the bank control and use to set price is levered and re-levered and hypothecated and re-hypothecated, maybe even 100 times. That means that there are 100 beneficial owners to every single 1 ounce that's out there. Well, that's fine as long as nobody's demanding that ounce for delivery. But if 1 or 2 of those beneficial owners all show up at the same time wanting that ounce, it's like musical chairs. The music stops and there's no place to sit. And if you're waiting for the system to collapse before you're going to go buy yourself some gold and silver, that's not going to fly. The price that, like I keep saying, is determined by this derivative trading. Because the derivatives are abundant, it makes you feel that the metal itself is abundant by looking at the price. When instead it's the derivatives that are abundant, but the metal is actually quite scarce. And one of these days, economic mother nature is going to fix things. Dave, we talk about that. The best example I get of this, so people can really put their hands around, is the gold-silver ratio. Mm-hmm. Everybody looks at that and goes, how could that be? It's 70 to 1. It's never been that high.
Right.
It should be 12 to 1. It should be 10 to 1. But it's 7. How come it's 70 to 1? That's the economic distortion of these paper markets. Of course it shouldn't be 70 to 1. But it's only 70 to 1 based upon this paper derivative trading, where the derivatives are in supply 70 to 1, perhaps. It's not the metal that hasn't changed. That historic relationship that goes back thousands of years, that hasn't changed. What's changed is we now price things off the derivative trading, and And the amount of derivatives in silver versus the amount of derivatives in gold is what distorts that ratio. It's sick. Anyway, it's not going to continue. It doesn't mean it's going to end next week, but people need to understand that this is all a falsity. It's all part of the scheme of the last 7 or 8 years to keep all these markets and by extension the global economy afloat. It can't go on forever, and while it's still being held together, you just have to use this time to prepare for the eventuality of what's coming.
Now, I wanted to ask you a question. President Obama did something very interesting, peculiar. He created this executive order about the order of succession within the Department of Treasury. Now, he's in his last term. The elections are coming up this fall. And I don't know if you heard about this executive order that he just created on August 12th, where, if something happens to the Secretary of the Treasury, then there's a line of succession, and things that could happen to the Secretary of the Treasury, might be that he resigned, he dies, something might happen in the country. When you're looking at this, and we know the economy is really not doing as well as they say, we know that manufacturing is contracting, we know GDP is manipulated, retail is awful. We're looking at all of these different things. We know unemployment is manipulated, stock market, bonds, gold. And we know right now that the economy is continually declining. We're coming off a lot of dead cat bounces, and things are rapidly declining quickly. And very interestingly, the Fed also released a report saying that, if we have a shock to the system, they're ready to do QE up to $4 trillion. And it's going to be a lot more than that.
Right.
But we see all this happening all at once. What is your take on all of this? And why would he do this now?
And then, it'd be fun to ask Jack Lew what he thinks of that, wouldn't it?
Yeah, I know.
Like, Jack, did Mrs. Lew come up to him that night and go, "What the hell is this?"
Yeah.
Maybe we ought to just quit now, and move to the beach. It makes you wonder. And maybe it's just, you never know. Maybe it's just a completely benign thing, but it does make you wonder about what type of structure they're setting up. Because if the Treasury Secretary were, at this point, you got to be confirmed by the Senate, right? And so they're instead setting it up so that they don't have to be confirmed by the Senate, meaning they can just put their man in place, just like Nixon put Ford in place, right? Knowing he hopefully was going to resign, but Ford, it's the same deal. It's all something that makes you kind of scratch your head. And you're right about the Fed. One, there was that report that said they could do as much as $4 trillion in QE. That's what, 1.5 times what they've done so far? Mm-hmm. That they stand ready to do that again? Well, that shouldn't be surprising. That's coming. And that's actually what was in the verbiage of Janet Yellen's speech at Jackson Hole last Friday, which is why, even though the headlines were scary and gold sold off in the first couple of minutes, that's why gold suddenly reversed and was $13.44 and kicking butt before they figured out, well, that's not the message that we want. And so Stanley Fischer calls up Steve Leisman at CNBC and immediately volunteers for an exclusive interview half hour later so they can doctor the message again, just like how they doctor the minutes to each FOMC meeting. Does it really take 3 weeks for some stenographer to go ahead and put all the notes from the Fed's meeting into a statement? And release them? Of course not. The Fed gives you headlines at the end of the Fed meeting that does or not, or does include, a dot plot, all the other nonsense. But if the market doesn't respond the way they wanted to, by 3 weeks later, then they release the supposed minutes so that they can change the message, right? It doesn't take 3 weeks for some government clerk to transcribe the notes, right? It's ridiculous. So anyway, putting it all back together, Mother Felon's speech last Friday was along the same lines. If you read it, it's all about we stand ready in the next crisis to come back in. Yeah, we may raise rates now, but we're ready with all this other stuff, just like the ECB and the Swiss National Bank and the Bank of England and the Bank of Japan. That's why gold shot higher and the dollar went lower and all this other stuff. And now for the last week, they've jawboned it all in the other direction. I do think if they do raise rates, the Wall Street economists that you see on Bloomberg and CNBC that talk about The Fed they need to raise rates so that they've got some ammunition to cut rates in the future. I really do think that that's what they're thinking, that they think, okay, this will give us but think about the lunacy of that. The economy's not doing jack now. And so you're going to hike rates just so you can cut them back to where they are today? What good would that do? Again, these banks are trapped. There was a news today, Dave, that a trial balloon being floated that the ECB is now considering buying straight up stocks, just like the Swiss National Bank and the Bank of Japan. I mean, it's madness, man. It's just not going to go on forever. And the desperation of the Fed and the other central banks to try to move the markets the way they wanted, or the way they want, is, man, it's palpable and you can see it. What was the report? You probably saw the report this week. What was it? Deutsche Bank maybe, that tried to quantify how much of the market move since 2009 is solely based on central bank liquidity and central bank activity. Did you see that?
Yes, I did.
It was half of it.
Yes.
I mean, but yet you're told in the media, and everybody that's got their fingers in the pie, oh yeah, well, this is a strong economy, and investors are making, rational and reasoned decisions to buy another 200 shares of Coca-Cola. Give me a break, man. I mean, it's all, they're trying to game everything higher to continue this facade that everything's okay, that the banks are healthy and everything's nonsense. But that facade is cracking, and it's going to continue to crack. And even though the next couple weeks probably see some downside pressure to the metals, that doesn't change my long-term opinion at all.
Do you think China being when it's included in the SDR basket, do you think this is going to be a game changer?
There's a lot of talk about that. The news was announced I don't even know when it was, December, January, is to be, and they give you 9 or 10 months because it's going to be included come October.
That's correct.
Whatever, 11% or whatever weighting it's going to take. It's not a game changer in at least I don't think that we're going to wake up in October and all hell's going to break loose. But it is another step in the broad Chinese plan that I'm telling my friends and family about this in 2005 and 2006. If the U.S. has had the exorbitant privilege, is what Secretary Treasury Connolly called it back in the 60s, exorbitant privilege of being able to just print the world's reserve currency. How have we printed all this money, gone into all this debt, but still actually been able to manage all of the inflation that should come with it? Because we've exported all the inflation to everybody else around the world. I mean, that was always Connolly's quote. It's the dollar's our currency, but it's your problem. And I started thinking, like I said, 10 years ago, why would the Chinese not want that privilege going forward? They're the largest creditor at this point of all of us debtor nations. They're the ones that are going to control the levers of power in the 21st century. And so, 2008 comes, they're buried in U.S. debt, and the whole system freezes up and nearly dies. I mean, if you're, some Chinese Politburo, whatever, at that point you had to be, oh, God, we're screwed too, right? Mm-hmm. And so they sat back in 2008. They did not have an alternative to this system. I mean, they were stuck to this current U.S. dollar hegemony that had been around for 60 years at that point. And then they have taken the time since, the 8 or 9 years since, to internationalize the renminbi, set up all these direct currency swaps, and begin to lay the foundation for an alternative. This inclusion in the SDR is part of that foundation laying process. So is it, a be-all, end-all, the world's going to change on October the whatever? No, but it's a significant historic date for the further internationalization of the yuan, the renminbi. And that day is coming, whether it's going to be a crisis for some new crisis, that crashes the markets and everything else. And the Chinese just say, hey, look at us over here. You don't have to play that game anymore. Here's our yuan and it's back with gold. And then the world changes overnight. Or, they want to be more nefarious about it and they just stick it in our face and say, then just do it on a Tuesday. Either way, the paradigm will eventually change. And the dollar will be challenged, and that dollar hegemony will be broken. And this movement of getting the Chinese yuan included in the SDR is part of that process. And so it's a big deal, but it's a big deal as part of the larger process that's coming this century.
When the system starts to break apart and it collapses, what do you think is going to happen to the dollar?
Well, that's a complicated question again. On a short-term or a long-term basis, because the dollar is paper funny money, just like all of the other major developed, if you want to call it that, world. I mean, whether it's the yen, the euro, the pound, the Swiss franc, whatever they're all, none of them are backed with anything. And so, if we're talking about, some big major market seize up meltdown like we had in 2008, dollar may very well rally, just because the developed world looks at it as, what's the old line, the tallest midget in the room kind of thing, right? But at the end, there is no way that the debt can be serviced. There's no way that any attempt to continue American society the way it's on the path that it's been going, there's no way that can be continued without almost unlimited devaluation and by creation of new dollars. I mean, anybody can look at that chart ever since the Federal Reserve came into existence in 1913, and how the dollar's been devalued. It now buys 2 cents of what it could buy then. And we've all sensed it, especially since Nixon closed the gold window. I mean, why is the middle income standard of living today so much worse than it was when my parents were raising me? It's because the Fed has, look at all the money supply that's been created since then, and the value of your accumulated savings and hard work, the way it's been devalued. They don't have any other option but to continue to do that. And so it's going to have a tremendous detrimental effect. So when you talk about what's going to happen to the value of the dollar, it could very well go up to begin with, at least in comparison to other fiat currency. But for your own personal well-being and what you can buy and the value of your savings, it's all going to be decimated by the devaluation of printing more.
Craig, I really appreciate you being on the X22 Report Spotlight. Once again, can you just tell people how they can see your work?
Dave, it's a pleasure, and I really appreciate you having me on again. My site has now been around for nearly 6 years. It's dedicated to what we call the end of the great Keynesian experiment, which is this massive explosion of debt and paper money to pay for it. If you believe that is an eventuality, as I and everybody on my site pretty much does, then we've got a great community for you. Most of it's free, but if you want daily analysis, the subscription is 40 cents a day, $12 a month. It's a great community of like-minded folks. We're all kind of realizing that we're in it together. So it's not like any other, so much of the cesspool of the internet. Everybody kind of treats each other respectfully, and we all try to help each other out. It's tfmetalsreport.com. I invite everybody to check it out. It's, I like to think of it as an island of sanity in this insane, crazy central bank world.
Craig, once again, really appreciate you coming on the X22 Report Spotlight. Thank you very much.
Dave, always a pleasure. All the best.
You too.